Okay, so today we're going to talk about the cash elements of employee benefits. So what usually happens when we think employee benefits, we actually don't necessarily think of like salary or cash compensation as being tied into employee benefits, but they absolutely are. They absolutely are tied to benefits. So we're going to talk about cash compensation for chapter 2, and then for chapter 3, when we get to that shortly, that's more on bonus. Okay, and bonuses tend to be treated, as cash items as well. Not always, not always, but they tend to be treated as cash items. So today we're in the world of cash, essentially. Okay? So it is the most, sizable portion of employee benefits. It's rare that you'll see someone who has a total compensation package of, let's say, $50,000, and half of that, be 401k, retirement plans, and things like that. It's more likely around 30%. So that means on the flip side that cash often makes up almost 70% of total compensation. For some, it may be significantly higher. For those who are self-employed, it tends to creep up into 85 or 90% because you're self-employed. You might not have access to the exact same benefits. It depends on how you run your business, of course. But sole proprietorship, more of your compensation is going to be cash, going to be your salary. So it's the core. It's what we know it's important from last week. It gets people in the door. That usually helps with the hiring process. Though recall that recruitment tends to be tied just to the cash, that's getting new people in. But one of the other R's, the retention, that tends to be more for the standard kind of benefits or traditional benefits that we think about. Okay, so one could say cash is king. Okay, but is it? So keep that in mind. We're going to go through some pros and cons here shortly of using cash. So again, a quick rehash from last week. Non-cash benefits, again, are about 30%. Well, that means the cash is about 70% of most compensation package. Okay? I'll give you another example here. Well, for self-employed individuals, what might they be missing out on? Okay? A little bit, right? So with benefits, a salary equivalent of $38,500 would be akin to just $50,000 in cash. Okay? So again, we're going from 38.5, 30 plus 30% is around 50K. So those are the benefits that we could be missing out on. So again, is cash king? Maybe. Everyone's different. Everyone has different preferences. Everyone has different preferences. So we do need to keep in mind, again, that there's not a one size fits all. Okay. So when we say things like cash is king is very important, and it is to bring in new people. People have different values, different risk preferences, different retirement preferences, different income preferences. Okay. And if you're curious on the stats, it says of last year. Now, so what we're going to do, keep that in mind that, okay, cash is important. We're going to go through pros and cons. We're going to talk about some, tax implications, though the short answer is that, if you're the employee, it's taxed. With the employer, there's very limited room for deferral. Very limited room. We'll discuss a little bit about some alternatives, being our other benefit plans. All right, so what are the pros? What are the advantages of cash? Okay. For employees, it's very simple. They know how much they get paid. They can divide that by, if they're getting paid weekly, bi-weekly, they can divide that by 26 and know how much they're supposed to get paid every 2 weeks. So it's much simpler. Okay. From the employer and the employee side of things. People tie it more to status. So it's rare for someone to go and say, all right, well, what was the tax advantage that I garnered by maxing out my 401k contribution this year? Like, oh, sweet. That's awesome. Not many people do that. They're more likely to say, well, what was my raise? Okay. Or what was I making 5 years ago and what am I making now? Or they might compare themselves to other people in the industry and say, well, I need to step my game up or I'm doing quite well. It's very easy to compare cash. A dollar is a dollar is a dollar. Now, from the employer side of things, most of that holds true too. And even further underline, or we further underline the simplicity by knowing that, hey, if we pay you, let's use the $50,000, if we pay you $50,000 a year, you're going to use that $50,000. You're not going to come back and be like, oh, here's 10 grand, I didn't need it. Thanks. Nobody's going to do that. Well, not many people are going to do that. I would say nobody. Very few people are going to do that. They're going to give money back. But they might not, the employees might not utilize their 401k. So you don't know if you're going to have to match or not. Now you can ask them beginning of the year, right? But you never know if they're going to utilize that to the fullest extent. But you give them $50,000 a year, you bet they're not going to write you a check back for 10 grand. Okay? They're not going to do that. But they might not utilize other benefits. They might not use their HSA funds that you put in as the employer if you're putting into an HSA. So there's more uncertainty there. So from a risk management perspective, ignoring all other things is like, well, we'll just pay cash and we'll be done with it. Okay? But that would be poor enterprise risk management because we're not listening to HR who's telling us that, hey, you have to offer other benefits to retain. Okay? To retain. Right. So those are the advantages. So mostly due to simplicity. Due to simplicity. The disadvantages, so it's taxed. Like for all intents and purposes, it's very, very difficult to defer cash compensation. Okay. So it has to meet, there's a typo here. I don't know who did that. Maybe me. It must meet reasonableness tests for deductibility, not destructibility. I'm not sure if destructibility is a word. Deductibility. So if we do try to deduct this, the cash compensation from the employer perspective, it has to meet a couple of reasonableness tests. So we can't just say, all right, I'm going to pay myself $500,000 this year. I only made 50 last year. Pay myself $500,000. That's payroll tax. I don't have to pay tax on that as the firm. So we are allowed as an employer to deduct that reasonable allowance. Okay? But therein comes the issue. What is reasonable? And the answer is, it depends. It depends. Pretty much anyone making less than $250,000 a year, which is about 98% of people, 98.5% of people, not going to raise an eyebrow. So this is more for that close to 1-ish%. Okay? Close to 1-ish%. So if they're not particularly high, again, particularly being above 99% of other people, then the IRS is like, okay, cost-benefit analysis, we're not going to go chasing after someone who made $60,000 a year when last year they made 50. Maybe they deserve that raise. But if you go from 250 to 500, okay, we'll look at that. So regardless though, from your perspective, if you find yourself either as the employer or as an advisor, what did we talk about last week? You need to document. Okay? If you're going to give these raises, if you're going to tie, when we talk about bonuses, we'll see it even more when it comes to like sales commissions, right? But you need to really, really iron out why you're giving these salaries. Because that's an expense to you, it's deductible as an expense. So you have to build that case. Okay. Now, what constitutes reasonable compensation? How can you do that? How can you build that case? If you have a wealth of others' positions in the industry to compare it to, boom, there you go. You create a nice distribution with, I don't know, even 50 or 100, and say, hey, this guy that we're paying him right in the average of that. Paying him or her right in the average. It's a very similar position, similar business, same qualifications. Okay. So the next point, qualifications. She was the only person with a math and finance PhD. The only person that applied was a math and finance PhD. So we have to pay her back. Because this compensation here, it's kind of, we're asking how difficult are you to replace? Okay? It's a scarcity thing. So it's not an intrinsic value, it's what you provide to the market. How much is this individual going to have to kind of take care of? What's under their umbrella? What's the scope of their duties? What do they have to do? You have a laundry list of things that they have to balance every single week. You have their qualifications, math, finance, PhD. You have the similar pay. You're getting there. You have a particularly complex business. And then I think the supply and demand here, that should always make sense. I think I've already covered that with this is the only person that applied that had a PhD in both math and finance. It's impressive. I stopped at just one. So when you're building a case, either for a client or for yourself, these things are important. Okay? These can build a very good case. This is not a collectively exhaustive list. Okay? And you might not need all of these. You might not need all of these. Okay? So what we do, we note the current IRS factors. Big one. You set those salaries before the year starts. Before the fiscal year, before we turn over. You set them before. If you start changing after the fact, that's going to make the regulators raise their eyebrow, if not both. The signed contracts are just to cover you. And then finally, the thing I'm going to harp on this entire semester, keep records. Okay? Keep records. Example of that, hey, if we have to go through a full hiring process and we have a team of individuals, they're going through the job search, so job search committee, ask them to take notes when they're discussing compensation or qualifications or why they choose this person over that person. I mean, from a legal perspective, that could help you too. But for reasonable compensation, it's definitely worthwhile. Definitely worthwhile. All right, so let's say that we do all this and we still come to find out that we paid this person maybe a bit too much. And let's say that we practice good risk management and say, well, we think this still might be a case. We think even though we're supporting all this, we think that the IRS might not like it. So what could we do? Well, there are reimbursements. There are reimbursements that's overpaid. Because of this uncertainty, we can enter into a reimbursement agreement. And we're saying if, hey, person with a math finance PhD, doctor, if we pay you too much, you'll have to pay that back. Okay? Or have to we'll call it reimbursement, sorry. So the excess. So whatever the IRS does not like, or the deduction. Okay. Now, that employee does not have to pay taxes on that. They never had that. So if it's an extra $50,000, they don't lose the $50,000 via reimbursement and then still have to pay their appropriate tax rate on the $50,000. Okay? So it's just coming back. So it could be that the net difference for them might be $30,000 or $35,000, right? Because there's a portion that's already been taxed, but they never had that, so the net difference. Okay? So if they paid $15,000 or so on tax and that $50,000 that they shouldn't have earned. but the net difference for them is the 35. So it won't be double taxed. Now this is good when we look at a lot of this is more for like executive boards or VPs of large institutions. Again, when we're looking in the $250,000 or $300,000 a year mark, that's at the 1% for the U.S. Give or take. Distributions are kind of weird, but right around 300. And it depends on the location too. Depends on the location. So in Muncie, if you're making 250, that's almost surely the top 1%. Okay, low cost of living area, right? And probably in the state of Indiana as well, that would be true. In New York, 250 is not going to be the 99%. You're not going to be at that top 1%. That might be the 95th percentile, maybe. So it does vary a bit. And that can factor in as well. Look, we've got this math and finance PhD, but we need her to live in New York. Okay? We need her to live in New York. So that's why we're paying her this much. And we still have a reimbursement agreement just in case. Now, another thing about reimbursement is they don't always solve the reasonableness problem. So you could be like, all right, we're going to pay her. She's living in New York. We'll pay her $600,000 a year. Okay, that's enough for the IRS to be like, what's going on? We'll look at this. But we'll have a reimbursement agreement for $300,000. So half of that. Half of that. So the question then, were I working for the IRS, were you planning on just paying them an unreasonable amount? And we think from an employee's perspective, that seems very unfair, right? Because they're missing out on income. And then you could be potentially getting a tax break if we don't call you on this. So you can't just cast out a reimbursement agreement and think it's going to, cover you. So it also kind of has to be reasonable. So it could also raise an eyebrow, or your book talks about red flags. This will be a red flag from an examiner's standpoint. All right. So for the employer, how can we go about deducting or paying these salaries? These salaries are expenses for us. So how can we go about deducting this? Because we don't want to pay taxes on something we're paying out. Right? So usually it has to pass the all events test, meaning that services have been rendered. Okay? In other words, if they're going to do something for you, your employee is going to help you 2 years from now, you can't deduct what you're going to pay them 2 years from now and then just sit on it. Because you have yet to pay that out. It's an arbitrage opportunity. You could take that money that you're supposed to pay them out or what you're saving on the tax deduction and invest it elsewhere. And you won't pay them for 2 years. So you can't push it forward. You can't defer it. It has to pass kind of this all events test. Services have to be rendered. You get some wiggle room. So you get 2.5 months. So that's when we have rules and for salary deductions. Okay. So the summary of these rules, because they do change, and this, in this class I would prefer us to focus on the non-cash benefits, so I've truncated this discussion a bit. But the summary is that they can't be taken before the year. So again, we can't go 2 years out. And once you actually pay the compensation. And if they're not rendered by the end of that year. You could do them prorated. It's like, all right, but we're going to have to pay them, $1 million, from, September of this year to September of next year. Can we at least count this year? Yeah, on a prorated basis, you can. This last quarter, you can count. But it still has to be during the period the services are rendered. So it would just be for that 3 months. So if you knew back in January they were going to start in September, you can't start deducting them. Now, there are rules that distinguish between what the current compensation is and what we're calling deferred, what we're deferring. So the gist is, current compensation is within that year that it accrues. That's when the deduction can occur. But deferred, it can't be deducted until the taxable year of the firm ends the taxable year of the employee. So it has to be included on the employee's income for their taxable year as well. So that's Internal Revenue Code 404. So it's, again, when I started with this and I said, basically it's taxed. It's pretty difficult. You're quite limited. And you have a 2.5 month window, but that's it. Quick note, what are the alternatives? So we're not getting tax advantages on this. There's no deferral at all really for the employee. What are the alternatives? Any other employee benefit, okay? Anyone that we've kind of at least touched in last week's discussion. And so these are still alternatives. These are different types of compensation. And we'll talk in just a second about maybe stock options will be next week, but that could also be tied to kind of bonus or incentive stock options too, which are discussed a little bit in the next chapter. So, some questions, okay? Some commonly asked questions. So this might be something that you could kind of use on PackBack if you want to, if one of your classmates hasn't already asked this question. So I guess you guys, being a Thursday class, might be a little behind on that. So say la vie, I guess. But if compensation is based on, let's say, profits, so commission, will it be deemed unreasonable if we just have a stellar year? We just knock it out of the park. Our salesmen and women are just killing it. The short answer is no. Not really. It won't be unreasonable. If you've done your due diligence, set the salary of the commission rate before that good year, not after, and done your other homework, right? Compared to other positions and just say, hey, this is a once in 100 years sales boom. And we'll see this in the next slides as well for chapter 3, talking about some bonus examples for sales commissions. And some of them we can see huge commissions where 100% of your salary or more, 100% of your cash compensation or more is based on commission. That's not uncommon. Okay. It's certainly not the mode, but it's not uncommon. Okay. If you want more information, have a case there. But again, that might be, you could probably tease out some PackBack questions from that, and you could cite the case and kind of go from there. Okay. All right, so that is chapter 2. Okay. First part of the lecture. Are there any questions on cash compensation? All right, so what I would like you guys to kind of get from this is really the advantages and disadvantages as you're going through this are going to kind of give you the most guidance when it comes to prepping for the exams, okay? Because there's quite a bit of useful information and kind of couching the pros and cons of all these. So that's probably what I want you to get the most out of this lecture here. Again, and this is very short because I think we all, again, go back to the advantage of cash. It's pretty simple. Talk a little bit about the tax incentives if there are any, and then we move on to the other employee benefits. Okay. All right. So speaking of that, let's look at chapter 3. And this, oftentimes we see this tied to cash as well. I think these two chapters complement each other. Let's talk about bonus plans then. These could be stock option incentives. These could be commissions of above a certain amount. So bonus plans. Bonus plans. Now, just to be clear, this is This is not generally set in the standard contractual agreement for the year. It might be an addendum. So it's an addition to your base salary. And we tend to see this tied as, or at least couched as a way to make sure our employees have some incentive, like they have skin in the game. So it might be tied to performance metrics. Sales is usually a pretty close one. For HR, it could be retention. Or for some functional unit of business, it could be retention. We harp on that a good bit here. So this is kind of the path I want to take for this chapter here. As always, I love a good pros and cons list. Weigh the costs and the benefits. So we're going to start with advantages, disadvantages. Taxation is always important, especially for most businesses and most employee benefit plans. Okay. The alternatives, which you've really already covered here, is just other benefits. How we can set these up. And then I have 2 common questions at the end of class that I'll let you go out on your own and think about. And then next week, we'll have a little brief discussion on those two questions. Okay. So I'll leave you with something fun to do, over the weekend. All right. Let's get to the advantages and disadvantages. So the first advantage, and when we really see these kind of propped up, or where we see them propped up, is based on incentives for employees. Okay, let's get them in on this. We're not just some place where they come, sit down for 40 hours a week, get paid, and leave. Okay. Have them have a vested interest. We can use that as a part of our strategy. I think the retention example is pretty good. Sales, being tied to sales is often quite good. You need to have a product or service. It can allow for some flexibility. And they're often relatively simple. Some are not even formally written out, notarized, or handled by an attorney. Some can be very informal. I had some bonus pay come to me a couple of summers back, and the agreement was via email. It said, hey, this is what we'll give you for this summer bonus. I trusted the institution and I got the bonus. But it was nothing more than an email. I mean, it went through the proper modes, it was taxed, it wasn't under the table or anything. But as far as a written agreement, there was just an email trail. Okay. Now, disadvantages. You can't, it's a lot like cash. The deferrals work in very much the same way as cash. Still have to be reasonable. Okay. And again, very much the same rules as cash. So I don't have much to say about the reasonableness test for bonus. Just go back to chapter 2. I mean, I have a little bit to say, but it's very, very similar. And it's for the employee, it's taxable, just as ordinary income. It's not like you can defer it. Now, taxation, again, very similar to cash rules here. Very similar. If we do want to deduct it from the employer side, they have to be reasonable and they have to constitute rendered services. That sounds very, very similar to what we just talked about for cash. In fact, it really is. Okay. There's a little more leeway on the reasonableness, allowance. Because firms can have amazing years. It just happens. Roll of the die, it just happens. So, one example here, or 2 examples, yeah. So, let's say that we have an employee of a $50,000 base salary. They kill it that year. And they have a $200,000 bonus. That's not unheard of. Okay? That's not unheard of. Would not immediately, be a red flag per se. So in and of itself, there's no red flag flying on that. But if the next year, the same employee for some reason saw a $250,000 base salary, there might be a red flag flying on that. Okay? Might be. So if it is a concern, decide the formula in advance. And we oftentimes see caps on bonuses. So a colleague of mine who's in the industry, private equity, his bonus is capped at 95% of his base salary. So it's capped at 95% of base. So you can only make almost up to twice your base salary. So in this previous example, if you're sitting at 50,000, that means you can only get up to about 95 or 97. To be fair, that's very low for private equity. That would not be what they would make significantly more than that. If you're interested. So like cash, you have to have services rendered. You have that leeway of 2.5 months. You have a little bit of wiggle room, but not much. So services have to be rendered. Now, alternatives, every other thing we've talked about so far. Okay, defined benefit, defined contribution plans. We roll kind of 401ks, HSAs, 403bs, 457bs, all these things that we have yet to dive into completely, but just there are other options. Okay. Now, if you're looking for incentives, the stock options could be that. Maybe a chance to buy stock at a reduced price, or just stock in the company if you hit certain measures and metrics. If you own stock in the company that does well, then great. That's incentive. I mean, there's always room. I won't say always. Almost always. There's room for some managerial conflict, some agency conflicts to arise. Okay? Even with stock options and incentives. But it helps mitigate those. Now, in setting up these plans, as I mentioned earlier, they can be very informal. I've never done one that was just a handshake, but again, an anecdotal example for me, I've had a bonus plan agreement via email. Were I an employer, or if you find yourself again being a fiduciary or advisor, I would advise against this. I would advise against you advising for this. It's best to have it in good, clean writing. Doesn't hurt to have an attorney. And it could be that they set up how you do the bonus structure for every employee, or at least every tier or structure of employee. You don't have to do it every time you want to have a bonus plan set up. You say, here's what we're doing for the salesmen and women, sales folk. Here's what we'll do for HR. Here's what we'll do for finance guys and gals. So written plan, again, that's documentation. Do your due diligence. And support why you're doing what you're doing. Assume that everyone's going to be skeptical of your choices. Be skeptical of your choices, of your own choices. Be more solidified that it's the good decision. Now, the two questions I want to leave you guys with. This could be a pack-back question. You could ask it and then kind of look up the answer. You could respond. I believe you can respond to your own questions. I've allowed you to do that. But what are the advantages of a written agreement? We could use the book, we could use the slides, we could use discussion in class. We could probably cite some external sources. So that's one that I want you to think about. And your book goes over these two. If you have the book, again, it's optional. Just recommended, I guess, is a better word. Recommended. And then the last question. What is the definition of profits? What if we tie something to profits, what do we mean by profits? So think about that. Figure out an answer to that for me. So that's your online, part of your online assignment, is to work on answering these two questions. The first one is pretty easy. This one's, you got a more direct answer. Okay?